The economy is flatlining.
It's been a tough ride on the inflation rollercoaster for Kiwis when it's come to spending power during the cost of living crisis.
Fresh GDP figures from New Zealand show the country's economy is moving backwards.
So, how is the CPI calculated and how often?
We've seen the first of the OCR rate cuts, and it is very unusual that there will only be one, right?
Our effective cost of GST as a percentage of our income is about 8 or 9%.
More people will be able to get into the market as the Reserve Bank eases its LVR restrictions.
OCR, CPI, GST, LVR, GDP. OMG, WTF.
Yeah, I think it is quite common that people sort of think that they're meant to know what these things mean and they kind of have an idea, but if they were asked to explain, it might be a bit of a blank.
Kia ora, I'm Amanda Gillies, and today on The Detail, we hope to fill in those blanks. This will be a beginner's guide of sorts to understand the economy, what changes mean, why numbers go up and down, and who makes the decisions. Money correspondent Susan Edmonds will break it down, including defining those 3 simple letters, abbreviations for financial terms that litter our business news.
We begin tonight with the OCR. A painkiller for mortgage holders, or are there more economic aches to come?
The GDP, a measure of economic growth, is up by just 0.2%.
The latest CPI figure has come in at just 2.2%.
OCR.
Official cash rate.
CPI.
Consumer Price Index.
GST.
Goods and Services Tax.
LVR.
Oh, that's a loan to value ratio.
And GDP.
Gross Domestic Product.
When I say the letters OCR, CPI, GST, LVR, GDP, does that make you smile? Or those sort of letters put you in your happy place?
I'm a lot more comfortable with them than I used to be. I can definitely say that. When I started out, I was a bit like, oh my goodness. But yes, as I've gone along, I think I'm pretty confident with all of them.
Excellent. So I want to start with OCR. What is OCR? What's the point? What does it control?
Okay, so the OCR is the official cash rate, and that's the rate that's set by the Reserve Bank. And basically what it is that it is what it charges banks to borrow money from it and what it pays if they are depositing with it. So it is sort of driving the cost of some of the bank funding. And so when the Reserve Bank increases the OCR, it in large part increases what the average household would pay or the average business would pay for their borrowing. And the idea is then, if it's more expensive to borrow, then you're less likely to do it, basically. So households are less likely to borrow and spend, and businesses are less likely to borrow and invest. And it just slows everything down a bit, which is what the Reserve Bank's trying to do when it increases the OCR.
How often is the OCR reviewed?
Okay, so it's 7 times a year that the OCR is reviewed. And it's, yes, pretty much, I would say, every 6 weeks or so for a while, and then there's a big gap over Christmas where we don't do anything for 3 months.
Why does the Reserve Bank move the OCR up or down?
The Reserve Bank's main job is to keep inflation within 1% and 3%. So if inflation is pushing up to the top, it wants people to cut back on their spending, businesses and households, just rein it in a bit, and then so it will put the rate up, and that makes it more appealing to save, less appealing to spend. And then if things are looking a bit dreary, as they are now, it will reduce the rate so that there's less of that handbrake on spending and activity and more reasons to get out there and do things, I guess.
How low do you think the rate could go?
I think I've seen predictions of 2.75 to 3 centish. I think that's probably not unreasonable. I think the Reserve Bank estimates that neutral, which is where it's not doing anything really to affect demand either way, is about 3.8. So I think we want to be a bit lower than that because things are not great for a lot of people at the moment. We need to get that activity going again. I mean, you just see retail stats are terrible. Construction's not in a great way. We need to get some things moving again.
Interest rates fell and mortgage rates dropped as the Reserve Bank delivered the second official cash rate drop in a row. The rate now 4.75%, a drop of 50 basis points from August, the first time it's been under 5 since March last year.
And it's been really high, over 5% all year. Why has it dropped now?
Well, it's dropped now because the Reserve Bank's confident that the inflation is getting back into, well, it is back in the target band of 1% to 3%. So basically, it's slowed down the economy enough that it can start to take that break off, I suppose. But it's interesting to note that it's actually the international factors of inflation that have come down first. So basically, the Reserve Bank's just confident that what it's done to slow the New Zealand economy will mean that that's going to come down to and keep inflation in a bracket that it's happy with into the future.
I think you said inflation then 3 times. How does the OCR affect inflation?
Yes, the OCR is the main tool that we have to manage inflation. So inflation happens basically when there's more demand than things can cope with, if that makes sense. Coming out of COVID, we had this issue because we kind of couldn't keep up with demand, and that drove inflation and prices up because businesses had to could put their prices up because there was so much demand. They couldn't quite keep up with it. So there was just this force in the economy that kept pushing prices up because we also had the supply chain issue.
This was from the peak of inflation in August 2022.
Stocking up on groceries is costing more than ever.
They're pretty horrendously expensive.
Unavoidably expensive.
No surprise with inflation at a whopping 7.3%. It's supposed to be between 1% and 3%.
I think for a lot of people it's a real struggle.
It's either are you going to eat or you're going to pay your rent. So I'd rather have a roof over my head.
So basically, if you have more demand than you can cater for, that allows prices to increase. But if you put interest rates up, then there's less demand, and that should lower inflation. The other aspect of the inflation we've had lately has been the labour market, because there's been such a shortage there of workers that wages have increased a lot. And so that's also increased what people can afford to spend and also put business costs up. So it just becomes a cycle. And so increasing interest rates is a way to kind of put a stop to that. And it's pretty uncomfortable, and it's been really kind of an awful experience for a lot of people, I think. But it is one way that we can just really slow down that demand and stop people spending.
Why does the Reserve Bank want to slow spending if inflation is high? Is that to protect consumers?
I suppose periods of high inflation aren't good for consumers because it erodes the value of your money and your assets potentially and things like that. So it wants to stop spending, so just to take that impetus out and stop the inflation pressure. And so that higher interest rates will keep it back in that. Well, the idea is that higher interest rates, when required, will bring it back into that target range.
What about mortgage rates? What impact does a change in the OCR have on mortgage rates?
The OCR isn't the only thing that drives the cost of mortgage rates because banks get their funding from a lot of places. But it is part of it, and it's particularly linked to the floating rates that we pay. So we've seen those come down quite a lot just lately since we've had those bigger cuts in the OCR. But we actually saw other interest rates drop before that because wholesale markets could see that the drop was coming and they're pricing it in, and so banks were able to borrow money at cheaper rates. So that came in, it brought down the longer fixed rates. And so those, I don't know, some people are saying that 5.6% that they're sort of settling at for the longer terms might be about as low as we go, but we'll have to see. But I think the floating rates definitely have further to go.
Probably a big question to ask, but is it better to fix or float your mortgage rates with the way it's all going at the moment?
Yeah, well, I'd like to have a nicely functioning crystal ball, but I think at the moment it's a lot cheaper to fix, though. I think it makes sense to fix rather than float. And then you just have to decide how long you want to fix for, because I think you can assume that probably rates will keep coming down for a little bit. So do you take the slightly higher 6 months and hope that it's lower in a year? And, you know, and you have to kind of do all those calculations of, is 2 6 months going to be cheaper than 1 year? And it can be pretty difficult. And I think for me, I just try and get the best rate that I feel comfortable with, and then just try not to think too much beyond that and just think, I've made that choice, I live with it, it's going to be all right. And at the moment, those 1 year rates aren't, I don't think they're too bad. I mean, we were talking about 5.65 from ANZ. That's pretty good historically.
What is the current OCR at the moment?
It is 4.75.
It's been described as an early Christmas present. The Reserve Bank has slashed the official cash rate by 50 basis points, bringing it to 4.75%. It triggered an immediate wave of interest rate reductions at banks, including ANZ, ASB, BNZ and Westpac.
And I think it was just over 5. So say, you know, if it goes over 5 to 4.75, does that cut actually make a difference? Can we really feel that? You know, are we celebrating or are we just going, whatever?
I mean, that is a big cut. It was, and some people are saying there will be an even bigger cut next time, but there should be at least the same. So it's coming down pretty fast. It was 5.5% not that long ago. But I think really, back to that whole confidence sentiment thing, as we see the drop coming through and people can see better times ahead, that will slowly change how they're feeling, and that will probably be the momentum that comes through, rather than that we have things that are, 50 basis points better. Do you know what I mean?
Yeah.
I think unless you're on a floating rate, you don't get an immediate impact anyway. So I think it is more that looking ahead to the future piece rather than, I've saved a small amount on my floating rate.
What does a drop mean for, say, savers and retirees? What impact does this have on them?
Yes, that is the flip side of this. And I think we often actually do forget about the people with money in the bank because it's not good news for them. But I have a feeling, I think it's fair to say that term deposits haven't come down as far as home loan rates have so far. So they're not suffering quite as much yet. But, I mean, they may need to rethink. I don't think they need to worry that they're going to go back to the interest rates that we had a few years ago. And I guess if the economy's picking up, then some of their other investments might do better, assuming that they're not just in term deposits. But, you can't avoid the fact that when interest rates are going down, it's good for borrowers, it's not so good for savers.
I'm a bit of a saver, so I'm kind of in that feel. What about though inflation is back under control at 2.2%, but at its highest, I think it was 7%, that was the end of 2022. Does this recovery mean we've actually recovered, or, we, average sort of Joe Bloggs, average person in New Zealand, are we still in a world of financial hurt, do you think?
Yeah, I think we are, because even though we're not at that 7 point whatever rate of inflation that we were at that highest point, prices haven't gone back. So our prices are still a lot higher than they were pre-COVID. And we've also got rising unemployment that's probably going to keep going for a while. Interest rates, some people are still rolling off onto higher rates, and it's not back to that 2 point whatever that we should have enjoyed more than we did at the time. And I think there's a lot of negative sentiment and confidence, and I think people sometimes don't put enough, I think maybe we don't put enough emphasis on that confidence factor, because I think people are still feeling that everything's a little bit grim and confidence might be picking up, but it is, it's not a great picture for some people. A lot of people probably.
We all go, oh my God, the boomers had it so much easier and earlier generations really benefit. Do you think this is actually true, or are we okay?
Anytime I make any comment about this, I get a lot of emails. But I think there are some things that you can't argue that they probably had a better time on, like house prices to incomes were just definitely better for the older generations than they are for the younger ones. I mean, their interest rates were higher for a while, but the amount of debt was much lower. So, and it wasn't forever that their interest rates were really high. Then they had a nice period of wealth building. And I don't know, it's not clear to me that young people now have that same opportunity to really ride that wave of growth through those sorts of same assets. So I don't know. Again, a crystal ball would be really handy. But I think in some ways, definitely those earlier generations did find it easier to get ahead than we might.
I'll say 2 words, good luck, because I'm sure you'll now get a lot of emails on the back of that.
I look forward to it.
You, though, just wrote about 7 ways that the economy has changed significantly. Can you talk us through these?
Yes. We can't really avoid the fact that the past few years have really changed the economy and how people are feeling about a whole lot of things. But I think there are a few ways that things have definitely changed, sort of maybe semi-permanently. One is obviously prices, which we talked about earlier. They're a lot higher than they were, and even though the rate of increase has slowed a lot, they're not going down. So that's a permanent change. Another one, I think, is probably, again, sentiment, the housing market. That had that enormous boom through the COVID years, and then a pretty significant fall since then. And that might have shaken some people's view that the housing market can only go up, it's a sure bet. That was a pretty tough experience for particularly those first home buyers who got into the market then.
House values are continuing to fall as interest rates rise and lending restrictions bite.
New figures show the average value has dropped more than 2% over the past 3 months.
Another one that a few people have brought up to me is government debt. We are in a much more indebted position than we were going into this experience, and that will have implications for the future. One that we sometimes, it's quite hard, I guess, to quantify, is the inequity and inequality issues in the economy, because sometimes things are much harder for one part of the economy than the other. And some people are saying a few changes that we've seen come through, like the indexing of benefits to CPI rather than wages, will mean that sort of differentiation between the poorer parts of the economy and the better off will be solidified, I suppose, into the future, as that because wages do tend to rise a little bit faster than CPI, and that's definitely the case at the moment. So that could be an issue. And also just that some things that we had before might not come back in the same way. I think we can expect international tourism will continue to pick up from here, but will it look the same? There are a whole lot of factors there that might change that, at least in the near to medium term. So I think it's just kind of like a new normal for the economy, and we've just kind of got to wait and see in some cases how things will play out, but in others we've got a bit more of an idea of what might be ahead.
Do you feel quietly confident, quietly positive?
I think I always feel quietly positive, and sometimes I'm deeply disappointed. But I think in general, I think it's got to get up better from here. I think we've seen that sense coming through in some surveys and things like that, that's sort of just, it can't get any worse. It's got to get better. But I mean, interest rates are coming down. The sun's shining. Apart from that awful stuff that's probably still happening in the labour market, I think things are generally improving.
So, if you still have questions or queries still at WTF, the Reserve Bank has kindly done an online OCR explainer as well. So, a quick recap.
The OCR is a powerful signal that the bank uses to dial up or down the cost of money. That is, interest rates that people and businesses pay when borrowing for everything from houses to cars to credit card purchases, or that they receive on their savings.
These interest rates affect CPI, consumer price inflation, and the level of activity in the economy. The Reserve Bank wants to keep prices stable.
If the economy overheats, higher interest rates can discourage excessive borrowing and spending and encourage saving, which helps to keep a lid on inflation. If the economy slows too much, lower interest rates can encourage the borrowing and investment the economy needs to grow.
The OCR sets the overnight rate for banks, so when it changes, banks will likely change their lending and deposit rates too.
And this spreads out over time from the major financial institutions to the retail market for businesses and households. Interest rates affect the decisions that we all make about saving, lending and borrowing money. For a 20-year house mortgage, a buyer's decision is affected by the interest rate today, but also by the rates they expect to see down the line.
Interest rates impact the Kiwi dollar. A trimming reduces demand.
A lower Kiwi dollar means we pay more for the goods we import. This raises the prices of the everyday goods we import, like cars and electronics. But our exports become cheaper for overseas buyers, which encourages exporters to grow their businesses. The OCR also affects what each of us does with our money, whether we decide to buy, or borrow, or save. If interest rates are low, people may renovate their homes. They may spend more and be less inclined to save. And if lots of us are spending more, businesses feel confident about producing more and investing in new technology and machinery to meet the extra demand. But as businesses work hard to produce more, there is more pressure on the limited resources in the economy. This pressure drives up prices, and the cost of everything from people's labour to the price of raw materials goes up.
Market chatter about what the Reserve Bank will do will grow again ahead of the next OCR announcement. The cycle will begin again, and hopefully you'll be IGT, I've got this. That's all for today. The Detail is a newsroom production supported by RNZ and New Zealand On Air. Thank you to Money correspondent Susan Edmonds. This episode was produced by Gwen McClure and Davina Zimmer and engineered by Jeremy Ansell. I'm Amanda Gillies, TTFN. Ta-ta for now.